Now, the investment route you're traveling is a good one because the stock has paid satisfactory dividends. And even with its ups and downs, the long-range price trend has been upwards.
Looks pretty good. Thank you. But before I invest, I'm going to study the facts myself.
That's right, Mr. Finchley. All investors should study the facts carefully before they buy any stock.
Hey everybody, Laura Trump here. I bet you haven't heard about all the accomplishments the president had this week because there's so much fake news out there. We wanted to give you a glimpse into his week. First up this week, let's talk about the president's salary. Again, the president has donated his salary. His second quarter salary has now been donated to the Department of Education. The stock market is up, the economy is booming, ladies and gentlemen, and jobs.
What? Oars and Austin? All right. What's your address?
Hello, Mr. Smith. Did you release the second bond issue in December?
Yeah.
All right.
Your cat did what, Mrs. Harris? Not really. All right, okay. Listen, Mark, some crazy stuntman is going to try taking off in an airplane from the top of an automobile this afternoon out in the valley. Sounds like a story. Hold it, Jack. Take off from an automobile on a dirt road. Can he make it? Well, be a good picture either way.
Every day in this country, we like to honor our American heroes. These are men and women who put their lives on the line every single day to make sure that we are safe.
Hello, my name is Michael Swanson. I run the website wallstreetwindow.com, and in markets like this where we're seeing wild gyrations and moves, they require a solid, old-fashioned investment and trading principles to navigate successfully. And that's what we're going to talk about today. This past week we saw the stock market take a dive following the announcement by the Federal Reserve that was going to raise interest rates by 1/4 point. And then the Fed projected 2 more rate hikes as a possibility in 2019. Before the meeting they were saying 3, but now they're saying 2. And much of the financial media blamed the stock market drop that followed on disappointments. They wanted lower rate hike projections. And now everyone's supposedly scared of all these rate hikes that are to come. But I'm going to tell you that this is not exactly what is really going on. But first, this is the Wall Street Journal, and it's pretty much typical of the reaction. You see the news right here, market shudder after Fed outlook. And what I want you to take away today is that it's not the Fed outlook that's really hurting the stock market. And as evidence of this proposition, I'm going to tell you 2 things. First of all, there are people that trade on whether or not the Fed's going to raise interest rates next year. And there's something called the Fed Fund Futures, and it's a very accurate predictor of that. And going into Wednesday's meeting, these people are projecting a 70% chance that the Fed would hike on Wednesday, and they hiked on Wednesday. Now for 2019, they're projecting 0. They don't see a rate hike coming at all. Now, even bigger than them, though, is the bond market itself. It's actually the biggest market, bigger than the stock market. You can buy bonds, you can sell bonds, you can do all kinds of things with bonds. That's exactly what people do. And when they do that, they make their decisions based on where they think interest rates are going to go in the future. And the bond market is saying 0 rate hikes for 2019. In fact, the yield curve is flattening on the verge of inversion. Look that up. I don't want to get into that, but you can find that on Google. The point is the bond market's saying 0 rate hikes. Fed Fund Futures is saying 0 rate hikes. So if the people, and it's not just that, let me give you another example. Gold soared on Thursday and really went up. If gold traders thought the Fed was going to raise rates, they'd be dumping their gold. They're buying more because easy money policies, which is what are going to come after the Fed stops raising rates or ends up having a reverse course, is going to weaken the dollar. It's going to make gold go up. That happened in the last two bear markets. From 2007 to fall, gold was the best performing thing in the world, except for the price of oil, until it peaked out in July. From 2000 to 2008, gold outperformed the Dow, outperformed the NASDAQ and everything when it turned around in the fall of 2000. And I think the same thing's starting. So we got three things telling us, three markets telling us the Fed's not going to raise rates in 2019 at all. So if the Fed's not going to raise rates in 2019, why did the stock market drop? And there's a couple really critical things going on there too that are going to impact all your investments. First of all, you got to understand that markets run in cycles. And we have seen the stock market fall for 3 months now. And when something falls month after month after month, it's no longer in a bull market. It's in a bear market, or a very negative market at least. And that's what we're in right now. So the drop that happened last week was only part of a bigger decline that had been going on since the beginning of October. And declines like that end in a panic washout, which we have yet to see in the market. Now, we can get a bounce, and I hope we do get a bounce in this coming week. I really am hoping for a bounce for people. But even if we do, I don't think that's going to be the bottom. We're not going to really see a bottom end of this for at least the first. It's not coming. It's coming sometime next year, so that means we can expect more selling once January hits. And when you think of things being in cycles, then you got to link that to interest rates. Interest rates aren't about one hike. In fact, the Fed has been raising interest rates for over 2 years, and the stock market has been going up until just the past 3 months. So if interest rates are negative, why has the stock market been going up while these rates have been going on for years? Because they're not necessarily negative. In fact, what makes stocks go up are rosy projections for more earnings growth to come, better economic prospects. And if the Fed, instead of saying we're going from 3 rate hikes to 2, said, hey, the economy's booming, we see more growth coming, we're sticking to 3 because everything's great, and that assumption or statement was backed up by real economic data, the stock market would be going up as we're speaking, not going down. So it's not the rate hike, it's the fact that we're at the end of a stock market cycle that began in 2009. We're at the end of an economic expansion also, and the evidence of that is that the people projecting interest rate policy in the financial markets and actually trading off of it are saying none. And that means we're at the end of the economic cycle. And when you're at the end of the economic cycle, that's negative for the stock market. The last 2 times the economy peaked out, the stock market went down substantially for 2 years the last time, and for 3 in the bear market before that. So that's what we're really facing. Winter is coming for the stock market, and the big question is, what do you do about that? And I want to first tell you, it's not something to be scared of. It's scary if you don't do anything about it, and if you're 100% invested in the stock market and you watch things go down month after month and you do nothing about it and you let this build up and you just get more and more scared. No, that's scary, but there's no need to do that. I don't believe anybody should be fully invested in the stock market because of the cycle that we're now starting. But not only that, there's no need to be, because there's things going up. Gold is going up. Since the start of October, gold has gone up. Last week, gold went up again. It's showing us that money is there to be made, and I expect gold to go up next year too. Other things are going to go up too, but gold is the most immediate thing starting to move now. And in between when the last economic cycle peaked out and the Feds changed their policy from tightening to ending to starting to lower rates, was August 2007. Gold took off that month and outperformed the stock market for over 12 months. And the same thing happened starting in the fall of 2000. So that's where we're at. Gold is a place to make money, but if you're fully invested in stocks, you can't make money in something going up, and you're in a very risky situation because look, stocks like Facebook are going down. Stocks like Apple are going down. Stocks like Nvidia are going down. How can I make such statements with such confidence? For one simple reason, because they're in downtrends. They started vicious downtrends. They smashed below their 200-day moving averages, and they've fallen far below them, so far below them, that those 200-day moving averages are now acting as resistance. That means they're in stage 4 bear market declines. Declines like this don't end until there's a panic washout. We haven't seen one yet. That means we must assume, even if the market were to bounce this week, that the next move will be down. More selling is to come. I know people don't want to tell you that, but I'm telling you that because that's what is in front of us, and I want to help you make money, not be a bag holder. And look at Facebook. Facebook is just, Facebook was a great stock in 2015, a great stock in 2016, okay in 2017, but this year it's been awful, 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 awful. Not only has it been awful, but Zuckerberg has been dumping his shares. Insider selling like crazy. He sold so much stock that we couldn't count the money if we had time to do it. I don't want you to hold stocks like that when the insiders are dumping. I want you to go where money is to be made in these markets, and that's what I'm here to help you do. And we got to be on top, yes, on top of the news, yes, on top of the trends and these situations as they develop, and I want to help you do that. This is the first time you've ever seen me. Go to my website, wallstreetwindow.com, join my free email list, subscribe to this YouTube channel, get the next email update. But things are changing. We've got to adapt to these changes. That's what this new year means. It means adjusting. It means seeing the opportunities in front of us. And when you think about the opportunities and not, oh, what's Facebook going to do? You can move forward. You can advance these markets and make next year a good year, and that's what we're going to do together.
Variable. In other words, there's a herding instinct in humans. There's all sorts of characteristics, and you put that together into a financial market, and it moves.
Do you think we're still in a bull market, an equity bull market?
Not really. No, it's beginning to fumble. You can see it by reaction in recent days. It would be very surprising to see it sort of stabilize here and then take off again. But it's happened in the past. However, at the end of that run for cover.